Hi everyone, my name is Kunal Punjabi and today I'm going to be explaining what is money supply. So we start with M0. Let's get right into it. What is M0? It's basically that category of money which refers to the reserve money and that represents what the central bank has issued and that in turn forms the monetary base of the economy, right? So it primarily comprises of all circulating currency within a country along with the bank's deposits that are held by the central bank. Now, the reserve money actually serves as a reflection of the total monetary liabilities on the central bank's balance sheet. This here on the right hand side is a chart which is depicting the growth in money supply over the last year. We look at some statistics now. So the actual value of the money supply is 47,503.95 billion rupees, which is the last reported value and the highest ever. So that is indicating strong economic activity in India, which is up from the previous figure of 46,890.84 billion. Now that is going to serve as our baseline for sequential analysis. The lowest ever, of course, was 931.78 billion, which is way back in 1991. So this reflects the fact that the economy has expanded by approximately 50 times in nominal terms over the last 34 years. Okay. Now, on a short-term basis, that is on a month-on-month basis, the money supply has grown by 1.31%. I'm only talking about M0 right now. It's grown by 1.31%. Now, this actually indicates that there's a strong near-term acceleration, potentially driven by some fiscal year-end spending, rise in consumer demand, or even some tax inflows. On an extrapolated basis, assuming a constant monthly momentum in growth, this actually implies double-digit nominal growth for the full year. And although this rate of growth may not be sustainable over a longer period of time, and that's going to be because of base effects and inflation volatility. The long-term CAGR from 1991 to 2025 is 13.64%. And as I said earlier, the economy has expanded from 931 billion to 47,500 billion approximately over the last 34 years. So this is very, very strong nominal growth, and that has been supported by strong structural reforms, demographic dividends, rising consumption, and of course, the dominance of the service sector. The nominal CAGR also does include inflationary effects, and therefore it's not a true representative of real GDP growth. Now, after adjusting for inflation, the real CAGR is something like 6 to 7%. That's quite a big gap, actually. And that is consistent with India's long term real growth trajectory. Now, some economic context and economic drivers. So, recovery momentum post pandemic is particularly in contact intensive services like hospitality, travel, and retail, which has seen a resurgence, and that has contributed to the growth in money supply. Additionally, robust private consumption. Let's go back to the previous slide. So, yeah, robust private consumption, which is supported by rising disposable incomes, rural recovery, and festive seasonality, have all contributed to the growth in M0. Additionally, sustained public sector capital expenditure with multiplier effects on core industries like cement, steel, and logistics, which has a very high contribution to India's GDP, have all played a key role in M0 growth. Apart from that, the production linked incentive schemes, which we've also seen in defense and electronics growing now, are driving the manufacturing revival. Elevated global commodity prices like crude oil and metals have been inflating the nominal output, so that's not true growth. It's giving an artificially higher output. We need to adjust for that. There have also been some tailwinds from improved financial conditions, credit availability, and stable macro policy stance, all of which have led to the growth in money supply. Lastly, strong GST collections and digital payment traction have reflected the formalization and tax policy in India, which has again led to the growth. Let's understand the effects of inflation now. The data that I actually reported in that table earlier is in nominal terms at current prices, which means it incorporates the effects of inflation. Now, this inflates the growth figures during the high inflation periods and may actually distort the real economic progress. Seasonality effects are also going to be pronounced, and let's look at the historical monthly patterns. So, March typically sees a 1 to 1.5% month on month rise, which is what I announced earlier, due to fiscal year end disbursements and advanced tax payments. So, truly, it's because of the seasonality that we are seeing an all time high in money supply. December experiences 1.2% month-on-month increase on average due to holiday spending and festive bonuses. So after adjusting for inflation, when you normalize the effects, you actually see that growth is not that high. Quantitative adjustments for these seasonal effects would revive the real underlying growth to a lower trend line. And a seasonally adjusted estimate for March 2025 would be approximately 0.3% versus the actually reported 1.3%. So inflation of 1% is what is pushing this figure up. Volatility analysis. So the standard deviation of monthly changes is approximately 1.4%. We need to account for that as well. This does imply a wider confidence band of plus minus 1.4% around the monthly data, and we need to keep that in mind when we're interpreting short-term moves. The CPI, which is at 5.3% versus the WPI, which is at 2.2%, has a divergence, and this implies that consumer sectors may face more real cost pressures, whereas producers benefit from lower input inflation, and that is actually skewing the nominal GDP growth towards wholesale heavy sectors. Some structural versus cyclical signals. Now, without deflators or real output segmentation, conclusions still remain indicative. So, the real GDP or IIP data are actually critical for confirming this. And of course, these are current prices, which is not adjusted for inflation, which overstates the growth during inflationary periods. Now, with CPI inflation, which is averaging 5.3% year on year in recent quarters, real growth may be substantially lower than the normal growth. Non seasonally adjusted data, that is, seasonal spikes, so you're actually trying to adjust for the seasonality. But if you can't do that, then you have non seasonally adjusted data. Now, that typically happens in March, right, which sees a 1% to a 1.5% hike on a month on month basis due to fiscal year end disbursements, tax collections, and elevated consumer spending. December also shows a consumption bump due to festive demand, which in turn is averaging 1.2% month on month over the last 5 years. Now, without the seasonal adjustment, it's challenging to distinguish the structural trends from the temporary effects. Real GDP or index of industrial production data, both of which are seasonally adjusted, are essential to isolate genuine economic activity. The month on month volatility or the standard deviation of monthly changes in non seasonally adjusted data, or rather NSA nominal output, has averaged approximately 1.4% over the last decade, making short term interpretations prone to some noise. CPI or WPI divergence can distort interpretation. Now, if the WPI grows faster than the rate of CPI, then nominal GDP growth may reflect commodity inflation rather than actual volume led growth. Some macroeconomic implications now. Positive indicators first. Now, this is a record high nominal value, as I said earlier. The latest monthly nominal value output is 47.5 billion, which marks a historical high. That is signifying sustained growth momentum. Broad-based economic engagement. So growth contributions appear to be distributed across consumption, investment, and the service sectors, which is actually suggesting a well-diversified and a healthy economy. Some seasonal momentum support as well. So March typically benefits, as I mentioned earlier, from end of year government spending, tax disbursements, which typically contributes 1 to 1.5% on a month-on-month basis. The fiscal multiplier effect. So public capex continues to stimulate core sectors such as construction, materials, and logistics, all of which is reinforcing the cyclical strength. Additionally, rising digital transactions and GST collections are indicating expanding formal sector engagement, which is a good thing. So now if we decompose this March growth, which is 1.31% on a month-on-month basis, 0.9% of that is actually attributed to seasonal trend, which is the fiscal year-end effect that I mentioned earlier, and only 0.4% is attributable to underlying real economic activity or inflation-led nominal increase. Month-on-month volatility for non-seasonally adjusted data 1.4%, which is implying that the current print is within one standard deviation of normal variation, though still slightly above seasonal trends. Things to watch out for. So, with CPI inflation at 5.3%, a portion of the nominal growth may actually reflect price effects rather than real output increase, with the real growth just being 0.3% on a month on month basis. Base effects and distortion need to be factored in as well. So March 2024, which is last year, was also elevated due to post-pandemic demand normalization, and year-on-year comparisons may actually exaggerate the growth momentum. There have also been some global headwinds, specifically from Brent crude, which was above $85 a barrel, elevated US yields, which was 4.3% for the 10-year yields, and FPI outflows, all of which did constrain macroeconomic stability. Some volatility risks that we imported as well. So the rupee depreciation combined with commodity inflation could actually transmit external shocks into domestic inflation and widen the current account deficit. Some risk scenarios that we see going ahead. Scenario A, which is a high inflation persistence. So if CPI persists above the 5.5% level, RBI may need to adopt a hawkish bias, tightening liquidity and slowing the credit growth. Scenario B, on the other hand, is a global slowdown where a slower global trade could actually dampen exports, industrial activity, especially in auto, textiles, and metals, all of which could be a huge hit for us. So, now a conclusion for this. Despite the impressive headline nominal growth, a deeper decomposition actually suggests that this marked uptick that we've seen is majorly seasonal and inflation driven. So, real activity remains moderately strong but not overheating as of yet. And the macro backdrop supports near term optimism, but we still need to be vigilant for exogenous risks such as the Trump tariffs, which are coming into play, for instance. So that's my analysis on M0 in the Indian economic sector. I hope you liked it. If you have any thoughts, you can drop it in the comment section. Thank you.